Well, the talking point on the floor clearly is around the US dollar and the potential for an impending reversal coming through. I will say that my gut instinct tells me that what we saw on Friday after the non-farm payrolls number, which came in better than expected, 209,000 jobs, the market's looking for 180. The wage growth of 2.5% was a 10 basis point increase or 10 basis point improvement from what the market was expecting. Participation increased, but yet the unemployment rate fell. This is a good jobs number, but it doesn't really change much, to be honest. The market pricing around the Fed funds market hasn't, really backs that point up. If you look at the January contract, which of course encapsulates the pricing around the December meeting, that has been anchored about 126 in terms of the yield for the last 7 days. So that gives us a 40% chance of a rate hike by December. That hasn't moved in 7 days. It's really anchored around these kind of levels, and that didn't actually move despite the payrolls number. So clearly, the market has said that doesn't change a thing. The US dollar, though, had its best one-day rally since December of last year, and that's despite what we saw with nominal bond yields on the 10-year up about 4 basis points and real yields only up 2 basis points. So it really doesn't justify an 80 basis point move in the dollar index in any shape or form. So this was short covering at its best here. The market had become too pessimistic, the positioning very one-sided. People saw a bit of good news. They've closed some of those euro-dollar short longs, closed some of those dollar index shorts, and ultimately you've left with somewhat of a more refreshed positioning, although it's still very, very long euros. The question then, if you have a look at the weekly chart of euro-dollar with the shooting star candle and the inability to close above the 200-week moving average, is are we likely to see some mean reversion coming through to where spreads are at the moment, coming down to say 115, around that kind of level? If they do, I think you've really got to have a look at how geographical equity allocation kicks in here. If we do see the US dollar strengthen, I think you probably will see some underperformance from US equities. We're going to start seeing European equities really find their time in the sun again. Have a look at the MIB. Have a look at the daily chart of the Italian MIB. It's really, really broken out. It looks probably the strongest risk-adjusted market out there. Political risk has come out of Italy with people like Beppe Grillo, polling worse than expected in some of the municipal elections there. BTPs over German Bunds have come in quite nicely, showing that sovereign risk the perception of sovereign risk has come in. So I like the Italian MIB. It's rallied despite the strong euro we've been seeing. But now we've started seeing the DAX moving high. You've started seeing the euro stocks breaking that longer term downtrend. I think if euro dollar does mean revert, you are going to see the European markets coming rallying quite nicely from here. Bear in mind as well that a lot of the fund flows into European ETFs, both in fixed income and equities, have done so this year unhedged. So if the euro dollar starts falling, people are going to start hedging that exposure, and of course that means selling euros, and that could cause it another leg down, which could propel European equities even higher here. So that's something that's very much on my radar. That currency translation is also quite important for Australia, where you've seen healthcare stocks really underperforming. Names like CSL, Cochlear, who also report this week, under a bit of pressure recently on that earnings translation. Aussie dollar dipped below 79 cents on Friday. It's just slightly above that level at the moment. But if we do see the US dollar finding its mojo, emerging markets under some pressure here, you are going to see those stocks doing well this week. I'll definitely be looking at that place for outperformance. The ASX 200 today should open on a positive note. We're calling up 24 points in line with the SPY. And I really think you've got to look at mining stocks and energy. We've seen energy moving up quite nicely on Friday, and the rig count's down 1. Not a huge move, but it's pretty clear that we have seen the rig count plateau, and that's positive for oil. It suggests that there is an elevated risk we push back into $50. Mining is obviously all about iron ore at the moment. Iron ore's flying. We've seen the spot price and the Dalian futures absolutely killing it at the moment. There's talk of what's happening in the steel futures complex or steel production. Some of the key production regions are curtailing their production numbers at the moment, which of course is great for steel, great for iron ore. But for me, that's where we stay long. That's the momentum trade. I think you probably stay long Fortescue at the moment. Obviously, CBA very much in focus with all the various PR scandals that are in place, or certainly the one PR scandal that's in place, and certainly everyone's focused on Wednesday's earnings. So that's going to be the big one at the moment. But for now, we're really focused on the dollar. Are we going to see an impending reversal higher, or was this just short covering of which to sell into? That's the question we want answered. This week it's all about Dudley speaking later in the week on Thursday night at midnight, and of course on CPI numbers that come out on Friday at 10:30. If you get a good number in that and Bill Dudley talks up the prospect of a December hike, the US dollar continues to rally here.